You just got your car insurance renewal. You opened the email, looked at the number, and your chest did that thing where it tightens up, and you briefly consider becoming Amish. $300 a month. For permission to drive the car you already own, on roads your taxes already paid for, with coverage you pray you'll never use. $300. Gone. Every month. Just for existing as a person who drives. And the worst part? You have no idea why it costs that much. You've never had an accident. You've never filed a claim. You've been a model citizen behind the wheel. But the number keeps going up. Every 6 months, every renewal, a little higher or a lot higher. No explanation, no breakdown, just a number and a pay-by date. Meanwhile, your buddy who drives a faster car in the same city with a worse driving record is paying $80 less a month. Same coverage, same company, $80 less. How? Why? What does this company know about you that makes your number different from his? The answer is everything. Car insurance companies know more about you than you think. They use that information in ways you don't expect. And the price you're paying is the output of an algorithm that weighs dozens of factors, some of which you can control and some of which you absolutely cannot. But understanding those factors is the first step to paying less, because most people are overpaying for car insurance, not because they chose wrong, but because they never understood the game in the first place. Let's fix that. Before we get into pricing, you need to understand the fundamental concept of how insurance works. Because most people think of insurance as, I pay money and if something bad happens, they pay me back. That's the consumer experience. But the business model is different, and understanding it explains everything about pricing. Insurance is a risk pool. Thousands or millions of people each pay a relatively small amount of money into a shared fund. When something bad happens to one person in the pool, a crash, a theft, a hailstorm, money comes out of the pool to cover that person's losses. The insurance company manages the pool, sets the prices, handles the claims, and keeps what's left over as profit. The key insight is that the insurance company doesn't know which specific individuals will have claims. They know with statistical precision that out of every 10,000 drivers in a particular group, roughly X number will have an accident, Y number will have their car stolen, and Z number will file a claim for weather damage. They don't know which individuals will have these events, but they know the rates and they price the pool accordingly. Your premium, the amount you pay, is the insurance company's estimate of your share of the pool's expected losses. If you belong to a group that historically has a lot of claims, your share is higher. If you belong to a group with few claims, your share is lower. That's the entire game. The company is trying to figure out how much risk you represent, price you accordingly, and make sure the total premiums collected from everyone in the pool exceed the total claims paid out, plus operating costs, plus profit. Think of it like a group dinner where everyone splits the bill based on what they're likely to order. The person who always orders the lobster and 3 cocktails pays more. The person who gets a salad and water pays less. Even if lobster person doesn't actually order lobster tonight, the group knows their history and prices them accordingly. Your insurance premium is the group's estimate of your ordering habits, based on everything they know about you. Here's where it gets specific. Insurance companies use a complex set of rating factors to determine your premium. Some of these are obvious, some are surprising, some might make you angry. All of them are based on statistical data about claim frequency and severity across millions of drivers. This is the most obvious and most impactful factor. Your history behind the wheel is the single strongest predictor of your future risk, and insurance companies weigh it heavily. Accidents, especially at-fault accidents, are the biggest rate killers. A single at-fault accident can increase your premium by 30 to 50% or more, and the increase typically stays on your record for 3 to 5 years depending on the insurer and the state. Multiple at-fault accidents can make you nearly uninsurable through standard carriers, pushing you into high-risk pools with dramatically higher rates. Traffic violations matter too, but the impact varies by type. A speeding ticket might raise your rate by 10 to 25%. A DUI or DWI is catastrophic. It can double or triple your premium and stay on your record for 5 to 10 years. Reckless driving, racing, and hit-and-run convictions are similarly devastating. Minor violations, a parking ticket, a fix-it ticket, an expired registration, generally don't affect your insurance rate. These are administrative infractions, not moving violations, and most insurers don't factor them in. The good news is that your driving record improves with time. Accidents and violations age off your record. A clean driving history over 3 to 5 years can significantly reduce your premium as those negative marks fade. Time literally heals your insurance rate. Young drivers pay more, a lot more. A 19-year-old male with a newly issued license can pay 2 to 3 times what a 35-year-old with 15 years of clean driving history pays for the same coverage on the same car. This feels unfair if you're 19 and a careful driver, but statistically it's rock solid. Drivers under 25 are significantly more likely to be involved in accidents than any other age group. They have less experience reading traffic, judging speed and distance, and managing the cognitive demands of driving. Add in higher rates of distracted driving, risk-taking behavior, and nighttime driving in the under 25 group, and the actuarial data is overwhelming. Young drivers crash more. Insurance for young drivers costs more. It's a direct statistical relationship. The rate drops significantly as you move through your 20s and into your 30s and 40s. Drivers in the 30 to 60 age range typically enjoy the lowest premiums, all else being equal. After 65 or so, rates tend to creep back up slightly as reaction times and vision decline with age. Experience matters independently of age. A 30-year-old who just got their license for the first time is also a higher risk than a 30-year-old who's been driving since 16, because experience, total time behind the wheel, is its own predictive factor. Your car. What you drive matters enormously. The insurance company evaluates your vehicle on several dimensions. Repair cost. A car that's expensive to repair is expensive to insure. Luxury vehicles, European imports, and cars with specialized parts cost more to fix after a collision. A fender on a BMW costs significantly more than a fender on a Honda Civic. The insurance company knows this because they've paid thousands of claims on both. Safety ratings. Cars with high crash test ratings from NHTSA and IIHS tend to have lower insurance costs because they protect occupants better, which means lower injury claims. Cars with advanced safety features, automatic emergency braking, lane departure warning, blind spot monitoring, can also qualify for discounts because these features reduce the frequency and severity of accidents. Theft rates. Some cars are stolen more than others. The Honda Civic, Honda Accord, and certain pickup trucks consistently appear on the most stolen vehicles lists. If your car is a frequent theft target, your comprehensive coverage, which covers theft, costs more. Vehicle value. A more expensive car generally costs more to insure because the potential payout on a total loss is higher. Insuring a $60,000 car costs more than insuring a $20,000 car because the insurer's maximum exposure is 3 times as large. Engine size and performance. A V8 muscle car or a high-horsepower sports car will cost more to insure than a 4-cylinder economy car. High-performance vehicles are statistically involved in more severe accidents, partly because they can reach dangerous speeds more easily, and partly because the demographic that buys them tends to drive more aggressively. The insurance algorithm knows this. Where you live is one of the most significant rating factors, and it's one you might not think about. Insurance companies price by zip code. Your specific location determines your exposure to a wide range of risks, traffic density, accident rates, crime rates, weather patterns, and the cost of medical care and auto repair in your area. Urban areas cost more than rural areas. More traffic means more accidents. More population density means more theft. More intersections, more pedestrians, more cyclists, more delivery trucks, more distracted drivers. All of it adds up to higher claim frequency. If you live in a major city, you're paying a premium for everyone else's driving around you, not just your own. Specific states also vary dramatically. Michigan, for example, has historically had some of the highest car insurance rates in the country due to its unique no-fault insurance system, which until recent reforms required unlimited lifetime medical benefits for accident injuries. That unlimited medical exposure made Michigan insurance enormously expensive. Other states with high average rates include Louisiana, Florida, and New York. States with lower average rates include Maine, Vermont, and Idaho. Even within a state, rates vary by neighborhood. A zip code with a high incidence of car break-ins, vandalism, or uninsured drivers will have higher rates than a low-crime neighborhood 10 miles away. You might pay hundreds of dollars more per year just because of which side of town you live on. Weather matters too. If you live in a hail-prone area, your comprehensive coverage costs more because the insurer expects more weather damage claims. If you live in a flood zone, same thing. If you live in a region with a lot of deer, and deer vehicle collisions are surprisingly common and expensive, that factors in too. This is the one that makes people angry. In most states, your credit score, or more precisely, a credit-based insurance score, is a significant factor in your car insurance premium. People with lower credit scores pay more, sometimes substantially more. The insurance industry's justification is statistical. Data shows a strong correlation between credit-based insurance scores and claim frequency. People with lower credit scores file more claims on average than people with higher scores. The insurance companies don't claim to know why. They just know the correlation exists, and it's strong enough to be predictive. Critics argue that using credit scores in insurance pricing is discriminatory because credit scores correlate with income, race, and socioeconomic status. Lower-income individuals and communities of color tend to have lower average credit scores, not because they're worse drivers, but because of systemic economic factors that affect credit. Using credit in insurance pricing can therefore perpetuate existing inequality. A few states, California, Hawaii, Massachusetts, and Michigan, have banned or restricted the use of credit scores in auto insurance pricing. In those states, your credit can't be used to set your rate, but in the majority of states, it's a major factor. Improving your credit score can meaningfully reduce your insurance premium, sometimes by hundreds of dollars per year. The coverage you select directly affects your premium, and most people either carry too much or too little because they don't understand what they're buying. Liability coverage is legally required in almost every state. It pays for damage you cause to other people and their property in an accident where you're at fault. It has two components. Bodily injury liability covers the other person's medical bills, lost wages, and legal damages, and property damage liability covers damage to their car and other property. Liability limits are expressed as three numbers, like 100, 300, 300, meaning $100,000 per person for bodily injury, $300,000 per accident for bodily injury, and $100,000 for property damage. Higher liability limits cost more but protect you from personal financial exposure. If you cause an accident with $200,000 in medical bills and your liability limit is $50,000, you're personally responsible for the remaining $150,000. That means lawsuits, wage garnishment, and potentially bankruptcy. The minimum liability limits required by most states are dangerously low, often $25,000 or $50,000, and are nowhere near enough to cover a serious accident. Most financial advisors recommend at least 100/300/100. Collision coverage pays to repair or replace your car after an accident, regardless of fault. It's optional if you own your car outright, but required by your lender if you have a loan or lease. The premium depends on your car's value and your deductibles. More on deductibles in a minute. Comprehensive coverage pays for non-collision damage, theft, vandalism, weather damage, falling objects, animal strikes, fire. Like collision, it's optional if you own the car outright, but typically required by lenders. Uninsured/underinsured motorist coverage pays for your injuries and damages when the at-fault driver has no insurance or insufficient insurance. Depending on the state, roughly 10 to 15% of drivers on the road are uninsured. This coverage protects you from being financially wrecked by someone else's irresponsibility. Medical payments or personal injury protection, PIP, covers your medical expenses after an accident, regardless of fault. PIP is required in no-fault states and optional in others. Most people have no idea what happens after they file a claim. Understanding the process demystifies the system and helps you navigate it better if you ever need to. You have an accident. You call your insurance company and report it. They assign a claims adjuster, a person whose job is to investigate the accident, determine fault, assess damages, and decide how much to pay. The adjuster reviews the police report if there is one, interviews the parties involved, examines photos of the damage, and may inspect the vehicle in person or at a repair shop. For property damage, the adjuster either writes an estimate or reviews estimates from body shops. If the cost to repair the car exceeds a certain percentage of the car's actual cash value, typically around 70 to 80%, depending on the state and insurer, the car is declared a total loss. In a total loss, the insurer pays you the car's actual cash value at the time of the accident minus your deductible, not what you paid for the car, not what you owe on your loan. The market value of the car right before it was damaged. If you owe more on the loan than the car is worth, which is common, especially in the first few years of ownership, you're stuck paying the difference unless you have gap insurance. For injury claims, the process is more complex and can take much longer. Medical bills, lost wages, pain and suffering, and long-term disability all factor into the claim value. Serious injury claims can take months or years to settle and sometimes end up in litigation. This is where having adequate liability coverage becomes critical. If you're at fault and the other person's injuries exceed your policy limits, you're personally exposed to a lawsuit for the difference. The insurance company also has subrogation rights. If another driver was at fault, your insurer may pay your claim first, and then pursue the other driver's insurance company to recover the money. If they succeed, you may get your deductible back. If not, you don't. Subrogation is essentially your insurance company going to bat for you against the other company. It's one of the underappreciated benefits of having good coverage with a good insurer. If you've had a DUI, a serious driving conviction, or been caught driving without insurance, your state may require you to file an SR-22. This isn't a type of insurance. It's a certificate that your insurance company files with the state proving that you carry at least the minimum required coverage. It's essentially proof of financial responsibility imposed on high-risk drivers. The SR-22 itself doesn't cost much, usually a $15 to $50 filing fee, but the insurance policy behind it costs a fortune. Being an SR-22 status means you're classified as a high-risk driver, and your premiums reflect that. Drivers with SR-22 requirements often pay 2 to 3 times normal rates, and the requirement typically lasts 3 to 5 years depending on the offense and the state. If your insurance lapses while you're under an SR-22 requirement, even for a single day, your insurer notifies the state, and your license can be suspended immediately. There's no grace period, no second chances. The system is designed to keep high-risk drivers continuously insured, and the consequences for non-compliance are swift. The SR-22 is the penalty box of car insurance. You can get out of it, but only by serving your time, maintaining continuous coverage for the required period without any additional violations. Once the requirement expires and you have a clean record, your rates gradually return to normal. But those 3 to 5 years in the box are expensive. The state you live in determines the fundamental structure of how accident claims are handled, and this directly affects your premium and your coverage requirements. In at-fault tort states, which is the majority, the driver who caused the accident is financially responsible for the damages. The at-fault driver's liability insurance pays for the other party's injuries and property damage. If fault is disputed, the insurance companies negotiate, and if they can't agree, it goes to court. In no-fault states, including Michigan, Florida, New York, New Jersey, and several others, each driver's own insurance pays for their own injuries regardless of who caused the accident. The idea is to reduce litigation by taking fault out of the equation for medical claims. In no-fault states, you're required to carry personal injury protection, PIP, which covers your own medical expenses. No-fault states generally have higher insurance premiums because the PIP requirements add cost. Some no-fault states also have lawsuit thresholds. Your injuries must exceed a certain severity or cost threshold before you can sue the at-fault driver. Below the threshold, your PIP covers you, and that's it. Above the threshold, you can pursue a tort claim for additional damages. Understanding which system your state uses helps you choose appropriate coverage. In an at-fault state, strong liability coverage protects you from being sued. In a no-fault state, Strong PIP coverage protects your own medical expenses, regardless of who's at fault. The deductible is the amount you pay out of pocket before insurance kicks in. It's the most direct lever you have for adjusting your premium. A $500 deductible means you pay the first $500 of a covered claim, and insurance pays the rest. A $1,000 deductible means you pay the first $1,000. Higher deductible equals lower premium because you're accepting more financial responsibility for small claims, which reduces the insurer's expected payout. Raising your deductible from $500 to $1,000 can reduce your collision and comprehensive premiums by 15 to 30%. That's real money on every payment. The trade-off is that you need to be able to afford the higher deductible if you do have a claim. If you can't comfortably write a $1,000 check after an accident, a $1,000 deductible is a risk. If you have an emergency fund that can absorb it, the premium savings over time will almost certainly exceed the difference in deductibles. Because most people don't file a claim every year, think of the deductible like the copay at the doctor. Higher copay, lower monthly premium. Lower copay, higher monthly premium. You're choosing where on the spectrum of I'll pay if something happens versus I'll pay every month regardless. You want to sit. Let's separate these into two buckets because the strategy depends on which category each factor falls into. Things you can't change: your age, your gender in states that allow gender-based pricing, your zip code unless you move, your car's theft rate, the weather in your region, the legal and regulatory environment of your state. These are baked into the algorithm and you're stuck with them, at least for now. Things you can change: your driving record, drive clean for 3 to 5 years and violations age off. Your credit score, pay down debt, correct errors on your credit report, keep utilization low. Your deductible, raise it if you can afford the out-of-pocket risk. Your coverage levels, adjust to match your actual needs, drop collision and comprehensive on older cars that aren't worth much. Your car, choose a vehicle with low repair costs, good safety ratings, and low theft rates. Your insurer, shop around. Seriously, this is the biggest one. This is the single most impactful thing you can do to reduce your car insurance cost, and most people never do it. They pick an insurer when they first get a car, set up auto pay, and never look at it again for years. Meanwhile, the rate creeps up with every renewal and competitive offers from other companies go unchecked. Insurance companies price risk differently. They use different algorithms, weigh factors differently, and target different demographics. The same driver, identical profile, identical car, identical coverage, can get quotes that vary by hundreds or even thousands of dollars per year across different carriers. This isn't a small variation. It's enormous. Two reputable, financially stable, well-reviewed companies can quote the same person rates that differ by 40 to 60%. The only way to find the best rate is to compare quotes. Get quotes from at least 3 to 5 companies every time your policy renews. Use online comparison tools. Contact independent insurance agents who represent multiple carriers and can shop on your behalf. Get quotes from direct-to-consumer companies and from traditional agent-based companies. The 30 to 60 minutes this takes can save you $500 to $1,500 per year easily. Loyalty to an insurance company is almost never rewarded. In fact, many insurers practice what's called price optimization. They gradually increase premiums for long-tenured customers who are less likely to shop around because they know inertia keeps people from switching. The longer you stay without shopping, the more likely you are to be overpaying. Your loyalty is being monetized against you. This doesn't mean you should switch every 6 months for the cheapest quote regardless of the company's reputation. Claim service matters. Financial stability matters. Customer experience matters. But those things should be evaluated alongside price, not used as an excuse to never check the price. Insurance companies offer a long list of discounts, many of which people qualify for but never receive because they don't ask or don't know they exist. Multi-policy, bundling. Bundling your auto insurance with homeowners, renters, or another policy from the same company typically saves 5 to 25%. This is one of the most common and most significant discounts available. Multi-car. Insuring 2 or more vehicles on the same policy usually gets a discount. If you and a spouse or partner each have a car, combining them on one policy almost always saves money. Good driver. Most companies offer a discount for a clean driving record, no accidents or violations for a certain number of years, typically 3 to 5. Good student. If you're under 25 and maintain a B average or higher, many insurers offer a discount, often 10 to 15%. If you're a young driver or have one on your policy, this is free money for decent grades. Defensive driving course. Completing an approved defensive driving or driver improvement course can reduce your premium by 5 to 15% in many states. Some courses can be completed online in a few hours. The discount typically lasts 2 to 3 years before you need to retake the course. Low mileage. If you drive less than average, working from home, short commute, using public transit most days, you may qualify for a low mileage discount. Some companies offer pay-per-mile insurance that charges a base rate plus a per-mile fee, which can dramatically reduce premiums for low-mileage drivers. Safety features. Anti-lock brakes, airbags, anti-theft systems, backup cameras, and advanced driver assistance systems can all qualify for discounts. Most modern cars have these features standard, but you may need to confirm with your insurer that they're being applied. Paperless and auto pay. Small discounts, usually 3 to 5%, for going paperless on billing or setting up automatic payments. Not life-changing individually, but they stack with other discounts. Telematics, loss usage-based programs. Many companies offer programs where you install an app or device that monitors your driving behavior, speed, braking, time of day, phone usage, and adjust your premium based on how you actually drive. If you're a genuinely safe driver, these programs can offer meaningful savings. The trade-off is privacy. The company is collecting detailed data about your driving habits, location, and patterns. Whether the savings are worth the surveillance is a personal decision. If you own an older car outright, no loan, no lease, you should evaluate whether carrying collision and comprehensive coverage is still worth it. These coverages pay to repair or replace your car. If your car is only worth $3,000 and you're paying $600 a year in collision and comprehensive premiums with a $1,000 deductible, the maximum you'd receive in a total loss is $2,000, the car's value minus the deductible. You're paying $600 a year to insure a $2,000 potential payout. Within a few years, you've paid more in premiums than you'd ever receive in a claim. A common rule of thumb: if your annual collision and comprehensive premiums exceed 10% of your car's current market value, consider dropping them. Put the premium savings into a dedicated savings account as your own self-insurance fund. If something happens to the car, you use the fund. If nothing happens, you keep the money. This doesn't apply to liability coverage. You should always carry liability because it protects you from financial devastation if you injure someone or damage their property. Liability is non-negotiable regardless of what you drive. Here's something most people don't think about until it's too late. Filing a claim has consequences beyond the immediate repair. A claim, especially an at-fault claim, typically raises your premium at the next renewal and can keep your rate elevated for 3 to 5 years. If you have a minor fender bender with $800 in damage and a $500 deductible, you'd receive $300 from insurance, but that claim could increase your premium by $200 to $400 per year for 3 to 5 years, a total cost increase of $600 to $2,000. You received $300 and paid an extra $600 to $2,000 in higher premiums. You would have been better off paying the $800 out of pocket and keeping your clean record. This doesn't mean you should never file claims. For serious accidents with significant damage, injuries, or third-party liability, filing a claim is absolutely the right move. That's what insurance is for. But for minor incidents where the out-of-pocket cost is manageable, do the math before you call your insurer. Sometimes the cheapest claim is the one you don't file. Car insurance is a risk pool. Your premium is your estimated share of the pool's expected losses. Your driving record is the biggest factor. Accidents and violations raise rates for 3 to 5 years. Age matters. Under 25 pays dramatically more due to statistical accident rates. Your car matters. Repair cost, safety ratings, theft rates and value all factor in. Your location matters. Zip code determines crime, traffic, weather, and medical cost exposure. Your credit score matters in most states. Better credit equals lower premiums. Your deductible is your biggest direct lever. Raising it from $500 to $1,000 can cut premiums by 15 to 30%. Shopping around every renewal is the single best money move. Rates vary by 40 to 60% across carriers for identical profiles. Discounts for bundling, good driving, good grades, low mileage, and safety features are frequently available and frequently unclaimed. Drop collision and comprehensive on older cars where premiums exceed 10% of the car's value. Don't file small claims that'll cost you more in premium increases than the payout is worth. Car insurance isn't random, it's math. Very specific, very detailed, very personalized math that weighs dozens of factors about you, your car, your location, and your history to calculate how much risk you represent. The number you see on your renewal isn't arbitrary. It's the output of an algorithm that's been trained on millions of claims and billions of dollars in data. You can't change all of the inputs. You can't change your age. You can't change where you live overnight. You can't erase an accident from 3 years ago. But you can change more than you think. You can raise your deductible. You can improve your credit. You can shop around every single renewal. You can ask about every available discount. You can choose your next car with insurance cost in mind. You can drop coverage you don't need. You can decide not to file a claim that'll cost you more than it pays. The people who pay the least for car insurance aren't lucky. They're informed. They understand the inputs, they optimize the ones they can control, and they shop aggressively. The people who pay the most are the ones who set up auto pay 6 years ago and never looked at it again. Don't be that person. Open the renewal. Read the number, and then get 5 other quotes before you accept it. If this video just saved you money on your next renewal, or motivated you to finally shop around, hit like. Drop what you're paying per month in the comments because I want to see the range across ages and states. And subscribe so you stop overpaying for insurance because you were too comfortable to spend 30 minutes getting quotes. Later.